All right, let us know if you guys have any problems seeing the webinar.
Also, feel free to chime in with any questions at any time. We'd like it to be as interactive as possible.
Yeah. All right, so we're doing a webinar on the dollar. King Dollar Long-Term Review. I'm Tony Marcucci with...
And I'm Dan Keegan.
All right, so it's a risk disclosure. It says past performance is not necessarily indicative of future results. And we all know that's true. You know, sometimes you win, sometimes you lose.
That's part of trading, and anything we discussed today,
it's all hypothetical.
It's all hypothetical, and we'll be referencing past performances, but like the disclaimer says, it's not necessarily indicative of future results.
Exactly. So Dan Keegan, he started out in the option business in 1978. He worked his way up in the Chicago tradition. He was a runner, a phone clerk, and a floor broker. In 1984, he was backed by the legendary trader Steve Fawcett and began a 20-year career as an independent market maker on the floor. Dan has also been in Futures Magazine, and he's a regular contributor.
And Tony's Central Michigan Chippewa, graduate with a degree in finance, and Tony actually started his trading career from his dorm room at Central Michigan. So those of you who don't think it's possible to do well from home, Tony's an example that you can. Okay, and Tony uses his background for helping to determine pricing inefficiencies. He has a good client list, and we're hoping you guys can really enjoy this webinar today.
All right, so as we stated last week, we're going to go over last week, like a recap from the last couple of webinars. So we'll just go on the most recent one. So based on Elliott Wave, we looked at 1350 to 1400 call spreads in May. Gold cost us, theoretically $500, and then we were also looking at a credit spread in the March puts, and it was 1250 to 1240 for a credit of 500. So we're looking at a net position of zero, without commissions and fees. And last I looked, gold market was trading about 1257.
Yeah, this is what the gold, I think it's 1257. What we talked about last week, based on the Elliott Wave, it looked like there was going to be an upside move in gold. So we established two positions. One of them going along the 1350, 1400 vertical spread out in May. That was for a $500 debit, and then we collected a credit selling the near-term March 1250, 1240 put spread.
Exactly.
Now, where are those trading at roughly right now, Tony?
So roughly right now, the credit spread is roughly trading for 300. So you're up like $200 or so, theoretically. And I think the call spread is about even value. I think it's still around 500 for the 1350 to 1400 call spread.
Yeah, you need a little more of a boost for that since it's that far out. But yeah.
Yeah, and we saw pretty sizable upside in the gold market this morning. Traded all the way up to about 1274, and then consolidated throughout the day.
Backed off a little, but it didn't really collapse.
No, exactly. So we're at some interesting levels. And here's I have the chart still up from last week's gold. It's kind of giving you an idea. And that webinar is also still available on our website. So if you'd like to go check that out and you don't know what we're talking about and you want to see it, feel free to sign into the website. I think you just have to enter your email and you can get that webinar for free. So now we're going to look at the dollar. And I first drew in, what I believe the market is looking like in the dollar. And we call this a contracting triangle under Elliott Wave. And so let me show you the current dollar market, because I think that's important first to see. So this is a chart of the dollar going back to 1974. And so the main area we want to try and focus in on is these last 8 years, from roughly 2005, to where we're currently trading. And this is the type of pattern I believe under Elliott Wave that we're trading in. And so this is, for me, it's a really interesting market to look at.
Seems to be in kind of a tight range, is that right?
Exactly, exactly. And if you can see, maximum value up here is around 92, all the way down to about 71, and you can see the market has just been condensing, or coming to a smaller market with shorter and shorter ranges.
Yeah, we look at the ranges here, and then we look, in the 80s were huge.
Yeah, exactly,
huge
big swings.
And then even in the
2000s,
late 90s and early 2000s, we had some major moves up here and then down. So then you're right. So it's almost like it's bottling up.
Yeah, exactly.
Like a volcano.
Yeah, and this is a pattern under Elliott Wave, to look at. So this is what they call a contracting triangle. There's also other continuation triangle. There's lots of different terms for it. But how I look at it is I try to be as unbiased as I can be about the market. I don't want to have an opinion that I think it's going lower or higher. All I'm basing my opinion on, based on Elliott Wave, is I believe when this market moves out, it should move the width of the triangle, the largest width. So if you look at it, in the dollar, it was 91.50 down to about 71. So you should look for roughly a move based on Elliott Wave of $20.50. Give or take. It's not a perfect science, obviously, but that's a big move, nonetheless.
To the upside or the downside.
Yeah, and that's exactly what Elliott Wave states. It doesn't say that the market's going to move lower. It doesn't say the market's going to move higher. It's saying when this market does eventually break out, it should move the width of the triangle, the largest width of the triangle. So when you get down to the pinch, where this market starts to make a decision and it breaks out of the triangle, you should see a pretty strong momentum type move to the upside or to the downside, the width of the triangle, roughly 20.50.
So it's like a coil that's just being squeezed, and it could potentially. Of course, when that happens is the key.
And that's the toughest thing to try and figure out is, does it happen tomorrow or does it happen a year from now? And that's one thing that's uncertain. But that's why I want to pay attention to the market, because I think the dollar, especially in the type of trading that we do in the commodity market, the dollar has a big bearing on whether prices go higher or lower. And so that's why I want to pay attention to it. And so let's go back to the chart of the dollar. And so you can kind of see where we currently are. And you can see that from 2005 until 2013, we really haven't been making any moves, higher or lower.
So it's been an 8-year bottleneck.
Exactly. And for me, this type of pattern under Elliott Wave is an indecisiveness of the market. The market isn't bearish or bullish. It can't decide what direction it wants to go, and you have the bulls and bears kind of fighting back and forth until a certain point, and then one of them wins.
So this with Elliott Wave, it kind of reflects what the fundamentals are, and this is basing the movement. People always say, is it fundamental or technical? Well, the technical kind of reflects what the fundamental is.
Yeah, right? And the market hasn't, we don't have a real reason to be bearish or bullish the dollar right now. And I remember back in this time period, especially in this 2000 period, the market was extremely bearish to dollar, and everyone was thought the dollar was going through the floor. And even even through periods of this, there's been thought that the dollar was going to fall off, and it hasn't. It's just continued to consolidate.
Well, it's kind of been, from looking at it from a fundamental aspect, it's kind of consolidated because all the central banks from around the world are just printing money like crazy.
Yeah, exactly.
So it's a matter of who's printing it faster.
Yeah.
Now, if either one stops printing, that currency will probably go up, or if one is printing faster than the others, that one will go down further.
Yeah, exactly, and that's what we've had, especially over the last maybe five years or so. It's been who can print the fastest.
Right.
What you're
right.
saying.
So if some start to back off, or if it turns out one has been printing faster than the other, then we're going to get a lot of volatility.
Exactly, and we've also come into this kind of a new period in the market. With Janet Yellen coming on board, so there could be a change in times here.
Mm-hmm.
And so all we want to do is trying to use Elliott Wave to determine, when this is going to happen, or, trying to keep an eye on it so we can benefit from this in the future. And I think this could also offer up a pretty good opportunity in the commodity markets especially. So I have it on a smaller time frame. And kind of there's two lines in the sand for me. So the two lines in the sand for me are this 83.50 down to roughly 80 level. And so what I would look for, because you can see back in here, the market actually went outside of these ranges and then came back within. And it, especially with these, they'll give you head fakes. The market, you'll think it's finally falling, and then it'll come back within the triangle. So what I would look for is I would look for 2 consecutive weekly or monthly closes outside of these ranges, in these 80 to 83.50 level. And wherever the market breaks out under Elliott Wave, it states, if the market breaks out lower, it states the market would break $20 lower. If the market breaks to the upside, under Elliott Wave, it states the market should rally 20 points higher, just based on the width of the triangle. So you'd be looking at some massive moves in this type of market. I mean, and it's, as you can see, it doesn't always come to the perfect point. Sometimes it does. Sometimes it breaks out before. Every market is always different in trading.
Right, absolutely. We see a lot of things repeat itself from one underlying to another, but yeah.
Yeah, so I mean, so this is the 2 levels we're looking at. And I think over the next 6 months, I think these are going to be pivotal levels. So I'm going to be watching this 80 level really closely and this 83 level. And that's kind of the line in the sand for me. And any sustained rally over those levels or sustained break below that level, I'm going to be...
Could start a trend.
Yeah, it could start a trend, and we could be looking at the official breakout of this consolidation pattern we've been having for the last 8 years.
So we resolved that it's going to happen. What we haven't resolved is when it's going to happen.
Yes.
Everything with trading, timing is everything.
Yeah. Yeah, if we knew it was going to happen tomorrow, we probably wouldn't be sitting here, we'll say that. Right. But... So this is the dollar on the weekly chart. You can see, and the other thing that we're going to talk about too is the volatility has been really tapering off. So that's the next thing we'll go into. So options with Dan.
Okay, here we're looking at the implied volatility of the options, and we're seeing that it's at a near low level. Now, implied volatility, what that indicates is how much premium is pumped into the options, okay? The greater degree of uncertainty, which means if you think it's going to go way up or way down or something, the premium is really going to be pumped into these options, okay? And it's basically not at its all-time low, but near it, and it's definitely in the lowest range. So what does that say to you? Well, it says that if you are anticipating a move, at least your point of entry into this trade is going to be low cost. Because if you're anticipating a big move, you're expecting either up or down, you have to pay premium in order to enter the trade. So with a low implied value, and when something's implied, that means the amount you're paying for the premium over that period of time. That's how large. If you're buying a straddle, that implies how big
the move should be.
The move should be. That's what option traders all around the world are kind of voting on it. And when whatever the straddle is priced at, that's what they're implying.
Yeah. So they're saying the market should move this, but not all option traders are always right. So that's how you could.
Right. And there's a great deal. Now, if something all of a sudden triggers, and like when Tony said, if it started to head down, you'd see a pump up, or head up, you'd see a big pumping of the premium levels.
Mainly because it's entering into a new price level, because this is like an unseen area.
Exactly.
Yeah.
Exactly. And we can even look at now this is the dollar versus the euro, yen, and pound futures, which is not exactly what the dollar index is based on, but they correlate so highly that it's indicative.
Yeah, the dollar is an index and it's a basket of all the currencies, and these are the biggest currencies.
And here's the S&P, the graph on the right. Now that's 2005 and 2006. The VIX was absolutely rock bottom, and then even in 2013, last year, it was pretty much rock bottom. 13 was probably where it was. It would deviate slightly above it, maybe a little bit below. And already in the first 5 weeks of this year, we've seen greater volatility, more premium pumped in the options than we did all of last year. Okay, we have a question from Bruce. It says, with the current price levels and low volatility, would it make sense to buy straddle? Actually, it would. Yes, that's the simplest volatility strategy that you would look at. Yes.
And that's what we're going to look at next too. Is some of the current prices. The other thing I'm noticing too about this is when these currencies have some high volatility. Also, it looks like the S&P VIX has some volatility as well, so they're a little bit correlated.
Yeah, in fact, remember in 1987, that huge sell-off in the stock market?
Yeah.
It was triggered by a dollar panic over the dollar.
Oh, really?
So the dollar is not only related to stocks, but also all the commodities, whether it's the agricultural products and obviously the
stock market
and the treasury market, all very tightly wound into the dollar.
Exactly. So pretty important.
Very.
To trading in general. So low IVL option strategy.
Okay, so now the implied volatility over the last, 10, 15 years, where's the high? Like around 16 or thereabouts?
Somewhere in there. That's what from what I saw.
Okay. So now, and it's gotten as low as in the 5s.
Yeah,
so
lower 5s.
So 6.5, maybe a point above the lows, but it's still very much at the low end. Okay, so if we go out to September, it's a 6.5 implied vol. Okay. So what Elliott Wave, as Tony said, it could make a breakout to the either upside or downside based on that.
Yeah.
So now would be the time, and with implied volatility, the options at an extremely low level, now would be the time you'd look to do something based upon that towards a long volatility position.
Yeah.
Another thing to look at is the options. Whenever you look at looking to establish a volatility spread, you want to look at upside, out of the equidistant out of the money calls and equidistant out of the money puts, and see which one is valued more highly. And what is that currently?
Yeah, I think it was, what did we say? I think it was skewed to the upside. Yes.
Right. I think they were.
Yeah, it was like roughly double, I think.
Right, a little more than double.
Yeah.
Equidistant out of the money calls to the out of the money puts. Now, when you see that, what that means is it's not the options traders aren't necessarily saying it's going to go up more so than it's going to go down. They're saying if it does go up, it's going to go up more rapidly than it would. Then the move will happen in a shorter period of time than it would to the downside.
Yeah.
And the reason for that is options are a wasting asset. So you almost have to pre-price them at a higher level because if it happens really quickly, then they explode in price. If it chugs along slowly, then the decay in the option kind of cancels out the pump up in the premium. Yeah.
So looking at some option strategies in the September expiration. So we're looking at a long straddle at the 81 strike price in September, which has about 212 days left to expiration. And looking at owning the put and looking at owning the call, roughly it would cost you about $310. So the market is kind of predicting that the market isn't going to move over $84 or below $78. Is that correct? Isn't that
right?
That's what the option traders are predicting the move should be.
Exactly, based upon the premium that's in the straddle.
Yeah. So they're saying that's roughly the move for the dollar for the next 212 days.
Mm-hmm. That's the expected or future volatility based upon it. It's like a reverse engineering process. You find out the dollar amount, and then you see the width of that, and then you figure out. Then you plug in the volatility.
Yeah. Okay.
Numbers.
Yeah. So that's what they're currently looking at. So that's where we're looking at, theoretically owning, is the 81 put to call straddle.
Mm-hmm.
And, as Dan said in the past, is this would just be the initiating position or the...
Right. You start out with one position, and then you work it from there. But the good part about this position is you have a defined risk already. Okay, whereas sometimes when you're just trading pure futures, if it goes against you, you have to throw more money at the position.
Yeah.
So this is a position that you know ahead of time what the money is that you have to throw at it. Doesn't mean you're just going to sit there on your hands. As it moves in a certain direction, there's a lot of different things you can do. In other words, if it moves way up and you're long that straddle, you're getting longer because those calls are going to have more value. So there's three things you could do. You could buy puts, sell calls, or you could even sell futures against it, depending on how large your position is.
Yeah, exactly. And, I think one opportunity with this type of, strategy as well would be, looking at, that current chart that I just had up of, right in here. Say you, you initiated this type of position and you don't think the market's really ready to break, as you get closer to this line, you could look at, using the other opportunities, maybe futures against your option, or, say it got to the top end of this range and trying to use the market like that.
Right,
As a
exactly.
possibility
Now we have it right now as we're wanting to straddle twice, and then the other thing we could do is we could sell the strangle once against it to trim our initial outlay.
Yeah.
So we do it twice, that'd be about $6,200, and we collect, $1,100 by selling the strangle once?
Yeah, exactly. And I have the strikes in there, 79 to 85,
mm-hmm.
which kind of puts it out of that range where we're looking for the market to break.
Okay, so that way we reduced our initial outlay to $5,100. That's a max we could lose based upon that. Now, we could sell another strangle if we wanted to, but if it happened to be that big burst at the time, it kind of negate the whole idea.
Exactly, yeah.
So if you didn't even want to do that, you could just go naked long the two straddles, okay? And then it'd be a little bit cleaner in terms of your adjustments, in terms of like selling the calls, buying the puts, or selling the futures.
Yeah.
So.
But yeah, that's sweet.
But about 90% of your profitability in any options position you establish is going to be adjustments you make, because things don't always work the way you want them to. So you're constantly adjusting.
Yeah. So we thought we'd kind of make a comparison of the market, kind of put into layman's terms, what we're looking at in the volatility. So I think a good market to look at, since it has such large volatility, especially on an intraday basis, is the crude market. And we're looking at straddles in the May expiration, which has 70 days, which is about 3 times as less, the one we were looking at. The at-the-money strangle is roughly 7,000. So they're saying currently, I think crude is trading at 90-40 day.
Yeah. So basically, your outlay is going to be more than double with 1/3 the amount of time. So that shows the option people believe that there's going to be much greater movement in recent history. There has, even though it hasn't been unbelievable volatility in oil, comparatively speaking, it has. It's not totally stuck in the mud.
Yeah, and I've seen, especially, I would say on average, there's probably about $1 swing in crude in every day.
Mm-hmm. Right.
Versus $1, which today was down, 0.1.
Mm-hmm. That's correct.
So, So we just thought to make a comparison. So compared to 200 days, the straddle is roughly $3,000. Compared to the crude oil market, which has much larger volatility, their straddle is 7,000. So they're expecting a 7-point move in a lot less time.
Right. So then obviously implied volatility for the oil is much larger.
Yeah.
It's due because it has been. Now, if the dollar finally breaks out, you're going to find this type of premium for the dollar.
Exactly. And so that's what we're looking at in these option strategies. That's the type of thing we're looking for, is the implied volatility to expand.
Well, that's why it is actually an opportunity for you at this point. Once again, doesn't mean it's going to work out. It could stay for another year like this.
Yeah. And we saw that in the VIX in 2005 and 2006.
Right, where it just didn't break out at all.
Yeah. My favorite thing you say is, they found a way to get rid of volatility in the stock market.
That's what some of the financial engineers were actually claiming, that volatility is no longer part of the market. The financial engineers have found a way to take it out because of the 2 years of
$9 what was it, 9 VIX?
Yeah, VIX was as low as 9, correct. Yeah. And then of course we saw a couple of years of just
50.
Record volatility, even getting up to 80 the VIX.
Yeah, exactly.
So the same thing could happen to the dollar.
Yeah. And so also I think the big opportunity too is the dollar is inversely correlated to commodity markets. And this means, so if the dollar goes lower, commodity markets in general should trade higher, and then in the reverse. So if the dollar goes higher, commodity markets go lower. So I think that's where also some of these opportunities could present themselves this year, would be the dollar market starting to move again, and opportunities across the board in all the commodity markets.
That's right. That's right, yeah. If the dollar moves either direction, you can see it reflected in the commodity markets, the treasuries, the stocks.
Yeah, so the key is, watching this breakout and trying to determine, is it a true breakout, or, is it going to stay within the contracting triangle? And so that's what we're going to be watching this year. And
does anybody have any questions right now?
I can see it. It's fine.
Okay.
So yeah, I'm not. We're going to do another commodity next week. I think, possibly on sugar. But
yeah, it's had quite a movement.
Yeah, just recently.
Mm-hmm.
And yeah, so we're going to be paying attention to the dollar a lot this year. I think that's going to be the key, especially for the commodity markets.
Right. And if the dollar does happen to tumble, you're going to see the treasury markets wake from their slumber as well.
Yeah, exactly. Well, maybe even the gold market as well, like we were talking about previously.
Right. Right.
So, well, if you guys have any questions, feel free to send us an email anytime or give us a call. The other thing too is that we're going to be putting all the webinars on the website. Also, you're going to be sent an email with this recording, so you can check it out later if you want to take a look at it, or any of the other webinars that we put out. But I think at this time we'll sign off. And thank you very much for attending.
Thank you, and we look forward to seeing you in the future.